Most people are told one simple rule about money: avoid debt, pay off your loans, stay out of credit card balances, and if possible, live completely debt-free. It sounds responsible, it sounds safe. But if you start looking at how wealthy people actually operate, something strange appears. Many of them use debt constantly. Real estate investors, billionaires, large corporations, even some of the richest individuals in the world. In fact, in certain situations, having more debt can actually make you more financially powerful. And that raises a strange question. If debt is so dangerous, why do wealthy people use it so much? To understand that, we need to look at something called leverage. For most people, debt is a burden: a credit card bill, a car loan, a mortgage that stretches for decades. It feels like something that must be escaped. And for many people, that instinct is correct. High-interest consumer debt can trap people for years, but wealthy investors often use debt very differently. To them, debt is not a burden, it's a tool, and sometimes it's a very powerful one. Because when debt is used strategically, it allows someone to control assets much larger than their own money. This is called leverage, and leverage has built enormous fortunes, but it has also destroyed many people who used it poorly. So why does it work so well for some people and so badly for others? The answer lies in what the debt is used for. Imagine two people. Both have $100,000. Person number one decides to avoid debt completely. They buy an investment with their own money. Person number two does something different. They use that $100,000 as a down payment and borrow the rest. Instead of buying one property, they control a property worth $500,000. Now something interesting happens. If the value of that property rises by 10%, the property gains $110,000 in value. The first person made $10,000. The second person made $50,000, not because he had more money, but because he controlled more assets. This is the power of leverage, and it's one of the main reasons real estate investors use mortgages. But there is another reason wealthy people often prefer debt over cash, and it has something to do with taxes. In many countries, interest on certain types of loans can be tax deductible. This means the cost of borrowing money can sometimes reduce taxable income, and for large investors, that can be a huge advantage. But the tax system contains another strange feature, one that many people don't realize. If someone owns an asset that increases in value, they often don't pay taxes until they sell it. So wealthy individuals sometimes do something surprising. Instead of selling their assets, they borrow against them. This allows them to access cash without triggering a taxable sale. And yes, some billionaires have used this strategy. For example, Elon Musk has historically borrowed against Tesla shares. Jeff Bezos has used stock-backed loans, and many real estate investors refinance properties instead of selling them. In other words, debt can sometimes allow wealthy individuals to access money while delaying taxes. But there's another reason banks actually like lending to wealthy borrowers, and it's not what most people expect. Banks don't hate debt, they love it. Debt is literally the product they sell, but banks also care about one thing above all else: risk. And here's where another paradox appears. Someone with significant assets can sometimes be considered less risky, even with large amounts of debt. Why? Because assets can serve as collateral. If something goes wrong, the lender can still recover value. That's why banks often offer wealthy borrowers extremely low interest rates, sometimes far lower than the rates offered to average consumers. In other words, the people who need loans the least often receive the best loan terms, which might sound unfair. But from a lender's perspective, it's simply risk management. However, there is one very important detail that often gets lost in conversations about debt. Not all debt is the same. Financial discussions often divide debt into two broad categories: productive debt and consumer debt. Productive debt is used to acquire assets, things that may generate income or increase in value over time. Examples include rental properties, business investments, or certain types of education. Consumer debt is different. Credit cards used for everyday purchases, expensive cars, luxury items that lose value quickly. In those cases, debt doesn't create wealth. It simply finances consumption. And that difference is extremely important, because the wealthy tend to borrow money to buy assets, while many consumers borrow money to buy things that depreciate, which leads to another strange observation. The same financial tool, debt, can either build wealth or slowly destroy it, depending entirely on how it is used. And that's why advice about debt often sounds contradictory. While leverage can create enormous wealth, it also comes with risk, because debt amplifies both gains and losses. If the value of an investment rises, leverage multiplies the profit. But if the value falls, the losses grow just as quickly. History has many examples of investors who used too much leverage. During the 2008 financial crisis, highly leveraged banks and funds collapsed when asset prices dropped. Real estate investors lost properties, companies went bankrupt, and financial markets nearly froze. In other words, leverage is powerful, but it is also dangerous when used recklessly, which is why the wealthy often combine debt with something equally important: large amounts of assets and liquidity. Because in finance, debt is not inherently good or bad. It's simply a tool. And like any powerful tool, it depends entirely on how it's used. When people hear that wealthy investors use debt, some assume that debt itself must be good. But that's not really the lesson. Debt is not magic. It's not automatically smart. And it's definitely not risk-free. History is full of investors who used too much leverage and lost everything. But when used carefully, debt can amplify opportunity. That's why corporations borrow money, why real estate investors use mortgages, and why financial markets are built around credit. Because credit allows capital to move, and capital, when directed into productive assets, can grow. But this also explains why financial systems place so much emphasis on credit scores. Because lenders need to estimate one thing above all else: reliability. Which brings us back to something interesting. The same system that warns people about debt is also built entirely around it. Debt itself is not the enemy. And it's not the solution either. It's a financial tool, one that can be used responsibly or dangerously. For some people, debt becomes a long-term burden. For others, it becomes leverage. And that difference usually comes down to one simple question: is the borrowed money being used to consume or to build something that grows? Because in the modern financial system, credit is everywhere. Mortgages, business loans, government bonds, corporate finance. The entire economy runs on borrowed capital. So perhaps the real question is not, is debt good or bad? But rather, who benefits most from the way it's used? And once you start looking at the system that way, many things about money begin to make a lot more sense.